सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We're one full month into the new financial year and we have fresh new data to discuss with you. There's no time like now to discuss how the economy is doing and maybe what it foretells for the upcoming financial year. So that's what we're going to discuss in this edition of Macrosutra. What do the high frequency indicators of the economy say about the health of the economy? I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And as always, we have with us Radhika Pandey, Senior Fellow at NIPFP. Thank you so much, Radhika, for joining us.
Sharad.
So now Radhika is actually, she's analyzed all of this data and she has come up with her findings. But before that, Radhika, I wanted to ask you, is the data showing that the overall recovery is happening in a kind of homogeneous way? The entire economy is recovering, or are there sectoral variations?
Yes, so the pace of recovery is very interesting, and it's in some sectors we are seeing much more sharper pace of recovery,
Okay.
and in some other sectors we are seeing gradual recovery. And when we talk about recovery, also there are various measures. Are we looking at, say, year-on-year change, or are we comparing with the pre-pandemic? Have we recovered from pre-pandemic? Have we reached the pre-pandemic level or not? Because we know that 2020-21 and 21-22 we saw a sharp decline. So in 2022-23 and then the current financial year, we are seeing a recovery. But is the recovery durable enough that we are able to surpass the pre-COVID levels? So there comes the different specificities of different sectors.
Right.
Some sectors have in some sectors, some categories have surpassed the pre-COVID levels, and in some there is a recovery, but it hasn't reached the pre-COVID level. So, and there are different factors at play. There are global headwinds at play.
Right.
There are seasonal factors at play. There is unseasonal rains and other things are also at play. So it's a very interesting analysis to look at the health of the economy at this point.
So basically, this is the kind of the India story, right?
Yeah.
Like there's nothing about India that you can give one answer that
Correct.
answers for the entire country. There are variations. The diversity is such that every little part, every little geography, every little sector has its story to tell. So then let's dive into it. Now, let's go by categories. Now, let's start with just overall economic activity.
Right.
So what does the economic activity indicators, first of all, what are the indicators you've looked at? And what do they say about economic activity?
So if we look at activity, there are some survey-based indicators like purchasing managers index for manufacturing and services sector, and they are why we look at these is because they are very timely. The month gets over, and the next day we get the data for getting some assessment about the manufacturing sector and services sector. And there, when we see that services sector has done extremely well.
Right.
It has soared to a 13-year high, and it is driven by increase in the demand for fresh orders. So what we can make out from this is that definitely the demand for services is picking up, and is picking up in quite a resilient way.
Right.
That it's risen to 13-month high. Similarly,
even last month was pretty high. It was
57, and now it's 62.
Right.
So it's quite high, even for manufacturing sector, which is it has also picked up. So if we look at these two, we definitely see that the demand, domestic demand, is picking up. At the same time, because demand is picking up, price pressures are also picking up within manufacturing and services sector surveys. So that is one kind of indicator that we look into. The other very interesting indicator is petroleum consumption, because that is a very useful and again very timely proxy for industrial activity, household consumption, and so on. And here it is capturing all the items: petroleum consumption, diesel, naphtha, LPG, and so on.
Right.
And there again, we have the latest data is available for March. And in March 2023, we saw the highest ever petroleum consumption of 20.5 million tons.
Wow.
So that is again an encouraging feature. And for the whole year also, we have surpassed the pre-pandemic level. So this is one, these are 2-3 indicators which show that economy is picking up. On the other hand, there are some other indicators like the core index,
Right.
which is index of industrial production for the core sector, where we look at production of electricity, cement, steel, all the items that make up for our infrastructure.
Right.
And there we get a mixed story, because cement is not doing well, electricity is not doing well, did not do well for the month of March.
Right.
Again, there are seasonal factors, because whenever there are rains, the demand for electricity will come down, the demand for cement and the movement of cement will get impacted. On the other hand, steel remained resilient. So overall, the core sector performance was subdued due to these factors, and it is made up of 8 elements, 8 components, out of which 3 did well and 5 did not do well.
Okay.
So these are some of the activity-based indicators.
But now, even when you mention the seasonal factors, the fact is that you're looking at the growth, the year-on-year growth rate.
Right.
So if you're looking at March over March last year,
Right.
then the seasonal factor also should be accounted for.
Yeah, seasonal factor accounted for if we look at March over March of the previous year. But I was also comparing with the previous month.
The month, right.
Because in the month of February, the core index did exceptionally well. So March was a problem because of seasonal issues. So that is one element to take into account, seasonal factors. So that is for the activity. And then similarly, we look at demand side indicators and so on.
So in this now, we saw the news about the GST revenue coming at the highest ever.
Yes.
That would also be some sort of, there'll be an activity related indicator.
Absolutely. So GST is again a proxy for transactions that are happening in the economy, both at the central level, state, IGST.
Right.
And there we saw that GST collections surged to 1.87 lakh crore in the month of April. And that is actually capturing the transactions of March. And there are a combination of factors to analyze. One is that, we have year-end seasonality here also. There is year-end bump up in sales that we do see for the last month of the financial year. So that has accounted for increased record collection of GST. But in addition, compliance is also playing a role. Government has cracked on fake GST invoices. Compliances has improved through e-invoices and a number of other measures. That has also led to improvement in GST collection. But the other factor is also inflation.
Right.
Where we, when we look at nominal GDP growth, which is cumulative of real GDP growth and inflation. There, nominal GDP growth is projected at 10.5%. Even if we assume that real GDP growth will be 6.5 and inflation will be 5, so 10.5 or 11% will be the nominal GDP growth. In that case, now we are getting the GST collection at 12% is the year-on-year growth of GST. So while it is a good growth, considering a nominal GDP growth of 10.5 or 11%, there is a scope for further improvement, because we talk about GST buoyancy, and there this the talk is about that how much change in GDP would contribute to how much change in the GST. So there is still scope for further improvement. So it's always better to qualify the GST numbers by also looking at what's happening to the GDP growth and inflation during that period.
Right. And so we did have a question from the audience about exactly this, the inflation effect, which you have now answered. The second part of their question, though, is which taxes depict the health of the economy better? Is it direct taxes or indirect taxes?
See, if we are looking at the health of the economy, I think both the taxes are useful, because GST also show the transactions. It is also showing how much e-way bill are happening.
Yes.
And it's a volume-based measure. That is not, it is showing the number of e-way bills that have transacted during the course of the month. So that is again a proxy for economic activity, but I think ideally one should also look at what's happening to direct taxes and corporate taxes, because that shows your propensity, that shows your capacity to pay more taxes. And here again, if we look at the provisional numbers for direct taxes that came up in the month of April for the full financial year FY23, it shows that government has surpassed even the revised estimates.
Yes.
So that is a very positive feature of growth of the economy, that shows that despite global headwind, the people's capacity to pay taxes has improved, both income tax and corporate tax. So these are the two direct taxes that we are referring to, and it improves. And therefore, so what is important is to look at the tax buoyancy. That is, when your state of the economy, when your GDP improves, how much you are able to influence through higher payment of taxes.
Right. Now, we've talked about the overall activity, which is broadly the supply side.
Right.
But coming to the demand side, which is, consumers buying things, companies buying inputs, all of that. What is that telling us? Like things like passenger vehicle sales or tractor sales. Yeah. What is that telling us?
Yeah. So again, it's a very interesting and heterogeneous story that is coming out of consumer demand. And one set of distinction is between urban demand and rural demand.
Right.
And within urban demand also, there is a trend towards premium products or high-end products. So if we look at passenger vehicles, overall, we see that it has picked up. There is, despite a high base of last year, we saw an improvement in passenger vehicle sales in the month of March. But what is important is to look at the composition. And there we see that the demand for small cars has plummeted, and the demand for sport utility vehicles has leapfrogged like
which are largely priced higher.
So what we are seeing is that there is a demand for premium products or high-end products. So passenger vehicle sales, it's always better to look at the category-wise demand. And there we are seeing a very interesting churn that is happening, that people are moving, they are upgrading their vehicle, they are moving towards high-end luxury SUVs, not even sedan. Even small cars or sedan, they are moving towards SUVs.
Right.
And that has also propelled even car dealers to reallocate their inventories or their designs or models towards SUVs.
Right.
And we know that now within the next 2-3 years, almost half a dozen of more SUVs are going to hit Indian roads. So that again, that is telling us something about the demand pattern of the Indian urban consumer, that there is a move toward premiumization and a spurt in the demand for luxury goods. Same thing we see even in the real estate sector. If you look at the housing demand, the demand for houses above rupees 1.5 crore has risen.
I see.
So there is this trend of premiumization that is happening across various consumer segments. So that is the picture on the urban demand.
But on the other side, looking at the lower end of the categories, if people are not buying smaller cars, two-wheeler sales also don't seem to be very strong.
Absolutely.
People aren't buying smaller houses. So does that tell us something about the lower end of the economy?
Exactly. It does. It does tell us about the lower end, that, even though there are green shoots of recovery there, but it's not happening on a very sustained basis. So one indicator of rural demand is tractor sales. So that has seen a robust growth over the last 4 months, and that is driven by a number of factors. Agricultural activity has picked up. There is a movement of harvest from field to the mandis. Then procurement is happening. So all that requires tractors. So there is a pickup in the demand for tractors for movement of food grains. We saw that in Punjab, procurement has already exceeded last year by 19%. So that means the arrival of wheat has increased, procurement has risen. There is a pickup in economic activity, and that is driving the demand for tractors. But on the other hand, the demand for two-wheelers is not picking up. Scooters is not picking up. And again, if what we see in April, if we look at what's going to happen in April when we get the data, there again, due to the unseasonal rain, which could have an impact on which could lead to crop damage, it would further suppress the rural sentiments and the demand would be impacted. So rural sector it would take some time before we can say with certainty that there has been a sustained revival in rural demand, and that's visible through a number of indicators. Even if we look at the demand for work under Manrega, it was coming down, and again in April it has picked up. Though again it's seasonal because agricultural activities get subdued after harvesting. But again it shows that there has been a pickup.
One other really important indicator in the economy is bank credit, because it drives some amount of consumption, it drives a lot of investment. So, but even bank credit, you can't look at it in a kind of composite way. You have to break it down into what kind of credit is growing how much. So first of all, is bank credit growing healthily, and within that, what is happening?
So again, bank credit, despite inflation, despite 250 basis points rate hike, bank credit has registered a growth of 15% in March, which also happens to be for the entire financial year, though it has tapered off from its peak. So peak happened in October when it almost touched 18%. But since then, due to increase in interest expenses, we are seeing some moderation, but still credit growth is robust. What is important is again to look two things. Firstly, to look at the composition of this credit, as you rightly mentioned. And second, to also look at credit in comparison with what's happening to deposits.
Of course.
Because, and that is captured by something called credit deposit ratio. So first, let's look at the composition. There, what we are seeing is that it's the personal loans and loans for services that is driving the demand for credit.
What would be a loan for service?
Services would be like NBFCs borrowing from bank is one prominent example, which is categorized as services. Then again, for travel, tourism, all these when these services entities are borrowing from bank, they are captured under services. So again, personal loans and services have been rising at a brisk pace, and almost 20% increase in credit we are seeing every month. Year on year change, and that has also led to increase in the share of personal loans in the outstanding credit. And that is what we call, there's been a churn in the composition of bank credit. Earlier, industry credit used to be the most dominant form of overall credit, and now it is personal loans, because from just a span of 5 years, from 18-19 till 2020-23, the share of personal loans has increased from 24% to 30%. And the share of industry has declined from 33% to 24%. And that is mainly due to slide in the share of credit to large industries. And that is also what we see in this financial year, that, there was a pickup till November, but after that, there has been a slide. So maybe again, when we talk about private investment, the initial signals were not sustained. We did see some improvement, but then it was not sustained. And maybe that is the reason that, the demand for credit by large industries were mainly for working capital requirement. So that is one very important dimension that needs to be seen. In credit deposit ratio, what we were seeing is that, credit was rising at 15% and deposit is rising at 10%. So credit deposit ratio is somewhere around 75%. But now what's happening since April, because this is a weekly data, it comes from weekly statistical supplement of the RBI. So we are in a position to also talk about what happened in April. Now what's happening is that the incremental deposits are picking up faster than credit.
I see.
So therefore, the credit deposit ratio, which was 75% till March end, has fallen to 71% in a span of just 2 weeks. So that is something very interesting that we will be seeing in the next couple of days.
That could possibly be a result finally of the interest rate hikes, because
yes.
deposits are now more attractive. You're getting more interest for your deposits, but loans are more expensive.
Absolutely. And even banks are also clamoring for more deposits. So therefore, this time around, we have seen a very good transmission of rate hikes, even in terms of both credit as well as in deposits, because banks are also, they need deposits to intermediate credit. So now we are seeing that the incremental increase is happening more in deposits rather than in credit.
I see. And now looking at overall sentiment in the economy, one kind of proxy for it, it's not a very accurate proxy, but it is a proxy, which is the movement of the stock market.
Right.
So how has that been doing? Like, what has been the performance, say, over the last year, and now in the last month, the latest data that we have?
Yes. So last year as a whole, we saw there was a very marginal uptick as compared to the previous year. But now what we are seeing in April, there was a good recovery. The financial year started on a good note for equity markets. And that is mainly driven by a combination of two factors. One is that most of the central banks have now started signaling that their rate hike cycle is coming to an end.
Right.
Last night, the Federal Reserve also raised the policy repo rate by 25 basis points. But at the same time, if you look at their language, it was that, more rate hikes, anticipation of more rate hikes would be data dependent. So the language was such that it was given a signal that more rate hikes would be forthcoming only if the bar is very high, if there is some unanticipated inflation shock.
Whereas last time they were very certain that
they are going to raise rates. So that is giving a signal to the market that rate hikes cycle is coming to an end. RBI also did not raise it this time.
Yes.
So therefore, all the rate sensitive sectors have done well this time. The real estate sector has done well. Metal sector has done well within the stock market category. The only sector which did not do well was the IT sector, which we discussed last time in great detail.
Factors.
It's all global factors. Also, the foreign portfolio investors who have been in more or less exit mode for most of the financial year, they have been pumping in money into the Indian stock market because of, firstly, they think that fundamentals are better. Secondly, rate hike cycle is coming to an end. And thirdly, the valuation, which used to be very high, because the stock market has somehow cooled. So the valuations are also better for them to start investing afresh.
Correct. And so now you mentioned, the IT sector, global factors. So then we have to talk about exports.
Right.
And within exports, of course, we have merchandise exports and services. Which of the two is driving our export growth right now?
It is services, and now people are talking about, services exports surpassing goods exports in the next 1 year or 2 years. Services export is going to become the driver, and that is what we saw in the current financial year as well as in the month of March.
Right.
Interestingly, in the month of March, the merchandise exports contracted by 13.9%. Services exports expanded by 13%.
Right.
So there was services exports is seeing a resurgence. And as we spoke in one of the earlier episodes, it's not just driven by IT, it's driven by the other business services, the other centers that have been set up, which are not just serving, but they are actually providing legal services, audit, accounts, and other services. So that is driving exports of services. So overall, despite global headwinds, we are seeing for the full financial year as such, exports have risen by 14% as compared to the FY22. So month-wise also services have done well. Overall year-wise also services have done well.
Right.
And that is giving an optimism that will also help in curtailing our current account deficit. Because if current account deficit rises too high, it leads to downward pressure on the rupee, and it makes the economy more vulnerable. So now most of the agencies have actually revised their forecast for CAD, current account deficit, because of the encouraging services exports.
Right. So there you go. The kind of the monthly data that we have is largely positive. I wouldn't say it's overwhelmingly positive. It's largely positive, and most of the positives seem to be driven by the services sector.
Right.
So whether you're looking at service sector activity as measured by the PMI, that's at a 13-year high. If you're looking at service sector exports, that's been robust through the year and it's continuing to be robust. All signs point that it will continue to be robust in the future as well. And services sector is also driving large parts of credit from banks, which is another very important pillar for the economy. But now if you look between urban activity and rural activity, urban activity seems to be recovering much faster. In a lot of cases seems to be better than pre-pandemic levels. Rural activity, on the other hand, still seems kind of tepid and dependent on seasonal factors. So we can't unequivocally say that the economy is doing amazingly well, but it is doing well. It's a lot of indicators are saying that we are doing well. So that's all we have for you. But before you go, I have an appeal to make for you or to you. A lot of the journalism that we do here at The Print, discussions like this, a lot of the data analysis, a lot of the ground reporting that we do takes a lot of time, effort, and money. And it's in this third regard that I make an appeal to you. Please subscribe to The Print. The link is in the description of this video. It's through your subscription and your contributions that we're able to continue this good work. And apart from that, subscribing itself gets you a lot of benefits. Number one, it gets you priority passes to our exclusive webinars and on-ground events. It allows you to write for us for the Your Turn segment, where you can write your own opinion as an article and we'll publish it. And finally, it gets you access to the newsletters that the editors of The Print write for our subscribers. It's about the news of the day. It's about our thoughts about the news of the day. And so it's well worth reading, I feel. So please do subscribe. The link, as I said, is in the description of the video. And thank you so much for watching.